Welcome all to this evening's webinar. Tonight, we are going to have some fun talking about cash value life insurance, but we're going to look at a very popular and very interesting strategy, which has to do with using a whole life insurance policy to pay off your mortgage. A lot of people we work with use this strategy. Tonight, we're going to go over how it works, why people do this, and then we'll look at some specific examples of clients that we've worked with and help them do this over the years, and then also clients we're working with right now. Before we dive into everything, though, we'll start with a quick intro. In case we've never met before, or if this is your first time watching any of our content, hello, my name's Steve. Great to meet you. Thanks so much for taking some time to learn about using a life insurance policy to pay off your mortgage. So that is a picture of me and my lovely wife, Tara, from many years ago. I've aged, she has not. In my free time, I like to teach just about 40,000 people all about whole life insurance and all of the things that you can do with it. I am the CEO and founder of IBC Global, which stands for Insurance Business Concepts, and we currently serve about 3,000 families, many of which who have seven-figure, eight-figure, and even nine-figure net worths. And we also serve the corporate market. One of our largest clients is a bank. It is a small bank relative to some of the major banks in the US and the world. The bank we work with is valued at just about $1 billion in assets. And really, our focus as a company with everyone we work with is you, not us. So concerning everything cash value life insurance and everything I just said there, I promise it is all true. If you'd like to have a conversation about life insurance and different finance strategies, I promise I'll do my very best to keep it interesting with you. But before I got into this and started IBC Global, I learned a lot about cash value life insurance at what is called an executive benefits planning firm. So it was here where I learned a lot, but specifically, I learned details about how to maximize the cash value in whole life insurance policies. I got to see firsthand how the super rich and ultra wealthy structure their policies and also how corporations structure their policies. My job at that executive benefits firm was specifically a case designer, which means I got to sit in a back office and help model the policies for corporations that were taking policies out on their executives. And the goal was always maximize the cash value up front because it's an asset on their balance sheet, and then look at how they can use that cash value, whether it's through policy loans today, and then taking income for their retired executives when they eventually retire. And then a big piece I learned while I was here was which insurance companies to choose. And this is a big piece in the life insurance industry because you don't need me to tell you that there are a lot of life insurance companies out there. There's tons of them. However, when we're looking at whole life insurance policies, specifically for cash value, I've seen four companies consistently deliver the highest internal rate of return, meaning growth rate on cash value. And they're considered your four major mutual companies, who are MassMutual, Guardian, New York Life, and Northwestern Mutual. But anyway, after learning all there is to know about whole life insurance and how to maximize the cash value, I decided to break off on my own and start IBC Global. So on the left, you can see my ride to work. The early days were rough, man. I didn't have a car, but I was able to drive an old four-wheeler into work, wear suit, jacket, tie, everything. I'm kidding. I didn't do that. But that was our office in the beginning. And the door you see on the far right, that is still the door today. And our studio is actually still in the same building, but it doesn't look like this anymore. You might not recognize it if you drove by, and this is the only picture you have to reference. So it's much nicer today as we have renovated it multiple times, and our team has grown too. Our company size is right at 30 employees, and every single individual that you see in this picture is very good at what they do in their specific role. So enough about me and the company. Let's get on into it and talk about how we can use a whole life insurance policy to pay off a mortgage. So What we'll cover this evening. Firstly, why people do this, how it works, and then we'll go through specific examples of real numbers. So the numbers you're going to see with this strategy are based on actual clients that we've done this for already or that we're doing this for right now. Firstly, though, why do people do this? There are three main reasons why. Number one has to do with the interest savings. In most cases, you will save a ton of interest executing this strategy. Number two, we can pay off our debt sooner. We can pay off the mortgage way earlier than planned, and you'll see two examples where people cut their time in half. One was much faster than half the time. And then here's the third one, which is huge. While I'm using a policy to pay off my mortgage, I'm also saving for retirement at the same time. And I'll go through exactly how that works. It has to do with how a policy works and how it's always compounding for me. So next, let's hit on how does it work? So step one, I get a whole life insurance policy, and my goal is not life insurance, it's the cash value. Meaning when someone comes to us, they express that they're interested in a whole life insurance policy for the cash value. It's very common to hear people say, I don't really care about the death benefit right now, even though it does have a long-term benefit. But step one, I get a whole life insurance policy. Step two, I take a loan from my policy to pay off the mortgage. Step three, after the mortgage is paid, I then repay my policy loan. And then step four, which really isn't a step, it's at the end, I have a lot of cash value. And again, you'll see examples. So firstly, how does the whole life insurance policy work? What role does the product play in this entire strategy? This is important. Here's the most important step. If you do this right, everything else falls in line. If this is not done right, it's not going to be efficient, and it's where people often have buyer's remorse. The policy must be designed for cash value. Again, otherwise, it is not efficient at all. So, how do I know if a policy is set up for high cash value? Well, here are a couple things you can look for. The first year, I should see about 85% of my payment show up in cash value. This is also the biggest drawback to whole life insurance. The worst year is the first year. But what this means is that if you pay $10,000 into a policy, you should see about $8,500 show up in cash value in the first year alone. The next, we have our break-even year. That should typically fall somewhere between 4 and 5 years. Our break-even represents the first year our total cash value is equal to or greater than our total payments. And then when we look at the annual yield, which is just the annual growth rate, not the dividend rate, when I look at it, it should fall somewhere between 4 and 5% annually after the first several years pass, and that is based on the current dividend rates in the industry today. Let's take a look at a couple examples, shall we? So we've got several illustrations up. And just to give you an idea of what you're looking at here, there we go. So you're going to see different illustrations. Here's one example with MassMutual, 10K per year going in. How much should we have in cash value in the first year? About 85%. This one has how much? Here's your money column, about 92%. So here's an individual putting 10 grand per year into a policy. Here's someone putting $100,000 per year into a policy. Here's your input. Here's your first year cash value, about 90%. So again, higher than that 85% figure we had mentioned. And then we've got an example where someone is throwing a large lump sum into a policy. So we see a $250,000 deposit up front, and then they fund a smaller dollar amount. Again, how much do they have in cash value in the first year? 236 and change. It's about 95% of what they paid into the policy available in first year cash value. Now, if you're looking at these illustrations and saying these things look like stereo instructions, Steve, what am I looking at here? Because that is often how people feel. We're going to take a look at them on Excel. In fact, let's take a look at them right now. So what we've got here is the example we looked at with 10K per year going in. So 10K goes in, first year cash value, $9,200 and change. This example was with MassMutual. The dividend rate with MassMutual is 6.40%. Anytime you buy any whole life insurance policy and you see a dividend rate, the dividend rate is not what your money is growing by. I repeat, the dividend rate is not what your money is growing by. We often see life insurance marketed in a manner where someone says, you're earning this dividend of 6% and you can borrow against it at 5%, which gives you a 1% spread. That is not accurate because a dividend rate is a gross rate applied to your policy after the cost of insurance. If I want to look at the annual yield, which is what I'm getting per year, we can include that in an Excel sheet. You can also run this in the illustration software, so you can get it from the life insurance company as well. And the IRR represents the average growth rate on a policy. That's 10K per year. Here's 100K per year. Different product with MassMutual. Very strong long-term. And the cash value is a safe place to put money. I can access it anytime. And it's also tax-free, provided we follow IRS rules and such. And there's the example with the $250,000 lump sum. There's my deposit. There's my first year cash value. Where we got the 95% from is in the first year, I take about a 5% loss. So 100 minus 5 gives me 95%. Okay, so why I always like to start with this is because when I'm looking at a whole life insurance policy, if I maximize the cash value first and foremost, that gives me more money in the policy, which I can then use to pay off my mortgage in this particular example. If I go with a setup that gives me less cash value up front and takes longer to get my money back, that is going to delay the time period in which I can then access my cash value to pay off my mortgage. Make sense? Okay. So, loans. Let's talk about this next. Why would I use a whole life insurance policy to pay off my mortgage instead of just using cash in the bank? Like, why not just throw extra payments at the principal every month, which is a good strategy to pay off the mortgage quickly? Here's why. With policy loans, my cash value keeps compounding when I borrow against it. Here's an example. If you have $100,000 in cash value, earning 5%, let's pretend you don't touch it. In 30 years, $100,000 compounding at 5% would be worth $430,000. Want to see an example? I would. So we got a nice little compound interest calculator here, starting with $100,000, 5% interest. Let's go down 30 years. Compound to $432,000 and change. So there is our $430,000 in 30 years. Now, if that's a 5% bank account, and we'll pretend for 30 consistent years, the bank pays you 5% every single year, which is probably not going to happen. But let's pretend that did happen. What would happen if you took $100,000 out and threw it at your mortgage? The 100 you took from your bank account doesn't get that 5% anymore, does it? No, we get 5% on whatever is left in the bank. So back to the policy. Here's why people do this. You've got that $100,000 in cash value. If you borrow $80,000 or any dollar amount, you'll still get that 5% on the full $100,000. So you get that constant compounding, which means if I have $100,000 today and I take a $80,000 loan against my policy today, and I pay it back 30 years from now, once I pay that loan back, my cash value is worth the same $430,000. So I have the peace of mind knowing that that cash value will continue to compound even when I take the money and put it to work. In this case, I'm applying it toward my mortgage. That make sense? Okay. So sometimes we hear this question, what's the catch? Well, it's not really a catch. It's just facts to be aware of. One, when I take a policy loan, I do pay interest on that loan, meaning the insurance company does make money. And if we go back to any of those examples where we looked at paying money into the policies, they were all designed for high cash value up front. They're all between 90 and 95%, but it's still a loss. So I take a loss up front. That's a profit for the insurance company. And then also because I'm negative in the early years, if I'm borrowing during those early years, that's also an additional profit for the insurance company. So it's really just seeing where they benefit and where we benefit. But one, I pay interest on the loan. And then two, my death benefit is reduced by the amount that I borrow. Would you like to see an example? Let's take a look, shall we? So what we've got here is a 35-year-old business owner. And I'll show you very quickly the actual illustration that we based this on. I like to put it on Excel because it does make things a bit easier. Here we go. Very nice. So this thing will look like stereo instructions, but here's what I might encourage you to look at. 50 goes in. First year cash value is 43 and change. Year 10 cash value, 268 and change. Keep those figures in mind. This will just give you assurance that I didn't make this up. We wouldn't do that anyway. So here we go. First, we've got the growth illustration. This is someone putting away a total of $200,000. He wants to fund it for a short period of time, 4 years. So you can see what he pays in. There's his total amount. What is highlighted in yellow represents his break-even point. That's the first year his cash value is equal to or greater than his total payments. We set the death benefit at a level dollar amount, mainly to illustrate how loans work. It keeps it simple. The cash value growth, this is an important column. This is showing you what the insurance company is paying you in total dividends and interest every single year. Look at it this way. Year 4, you've got 200. Year 5, you pay 0, and your cash value is 210. It's about 5% net. Comes out to $10,000 in total gains. That's the growth over 1 year that you received from the insurance company. So let's look at loans. We've got the exact same policy. He takes a $150,000 loan. There's your loan balance. Why it's going down is because we are repaying the loan at $40,000 per year until it's paid off in full. The loan interest, by the way, with this example, is just a touch over 5%. It's 5.07%, I believe. But of those payments, we can see how much of our payment is applied to loan principal and how much is applied to loan interest. This is nice because I can see year by year what exactly am I paying to the insurance company in interest. I like that transparency. And then I've got my cash value and death benefit. So I'd focus on one thing on this illustration to make it simple. Look at the 10th year when he's 45. His cash value, 268 and change. His death benefit, 800 and change. Compared to the left. Wow. Exactly the same. So why it's exactly the same is because when he took this $150,000 and it was outstanding in loans, it kept on compounding, meaning the cash value growth, he continued to receive that as if he never touched the money in the first place. This is why I would use a life insurance policy, again, instead of using a bank to pay off a mortgage, or I should say just money in the bank. And what some people like to see is the net cost, which I'm a fan of. So what this shows Here we've got that same cash value growth column. Here I've got my interest column, and it allows me to see whenever I pay any loan interest, what am I paying in loan interest? And I can directly compare that with the growth in the policy. Then I see I've got a positive spread. But if I took a loan earlier, that might not be the case. So it's always good to look at policy loans before taking them. This is easy to model. We can do it in the illustration software. We've got our own loan workbook, but this is easy to model. So I have transparency to see what is the net cost to borrow and make sure that I don't have a negative spread. A lot of times people get upset when they are led to believe that they have a positive spread on their policy and then they find out they don't. It happens quite a bit just when you look at the life insurance industry. All right, let's continue on, shall we? Paying off the mortgage. Now we're going to get into the meat of it. So everything we just learned about the policy, I hope that was helpful in terms of setting a foundation. Here's what I would do when it comes to paying off the mortgage with a whole life insurance policy. Step one, look at things based on what you're doing right now. Meaning if you just keep doing what you've been doing and making payments toward your mortgage, one, how many years will it take to pay that mortgage off? And two, how much interest will you pay to the bank in total interest payments? This is my favorite place to start because it sets a foundation to see what am I doing now? And if I do something different, is it better or worse? And then I can see it side by side. We're going to do exactly that as we go through everything too. So step one, review the mortgage. Step two, review your cash flow. This one's huge. Number one, are you saving money? Two, if no, can you save money? Three, do you have extra cash on hand? Remember that example of the policy where we saw someone funding $25,000 per year, but the first year was $250,000? That was someone who could save a little bit more than $2,000 per month, but they had extra cash on hand that they wanted to lump sum fund the policy with. So that's what I mean by question C, do you have extra cash on hand? So if we're currently not saving money and we cannot save money, we do want to work on that first. And some of the things we do to help people in a situation like this is really just review where their money is currently going. Am I saving money toward checking and savings? Maybe it's my 401k or retirement account. Maybe I'm putting it somewhere else. But see where the money is going and see if it's going anywhere inefficient or somewhere that I might look at it and decide to redirect some of that cash flow to a whole life insurance policy for the strategy. But what I'll add, this is kind of 2A, is if we're going to redirect cash flow from somewhere else, here's the question that we want to ask together. Does it make sense? If you're already doing something and it's working and you're going to redirect that toward this, we would look at it. We would compare what you're doing right now with putting money toward the policy with the intent to use it for the mortgage. Again, this way we can just see the numbers and coach you through that so we make the right decision. When I just make a decision blindly, that's typically where I have buyer's remorse lately. So with all of that said, the question is, how much can you put into a whole life insurance policy? That's it. That's the end goal of reviewing your cash flow because we want to fund the policy to then use it to pay off the mortgage. All right. Step three, start a policy. Pretty straightforward. Number one, fund the policy. And then what we do as each year passes is review the performance and make adjustments as needed. What I mean when I say make adjustments is life's going to happen for better or for worse. I've seen it happen to everyone over the years at so many different levels, and we just want to make sure the policy is set up so we can make pivots. We can build a perfect plan, but then if life happens, that plan is going to change. So that's where those reviews really come into play, and they're important. But again, step three, start the policy. Step four, here we go. Use the policy to pay off the mortgage. There's two ways you can use a policy to pay off a mortgage. Step one, or I should say option one, is chunking. For our Velocity banking friends, you know exactly what that word means. So let's hit on this one first. Chunking. What I'm going to do with this is borrow against my policy to pay down my mortgage in chunks. If I go this route, I am going to save the most interest, but it does require, call it additional maintenance, attention. There's a couple things I just want to make sure I'm always focusing on here. One, I want to account for money I am paying toward the premium and PUA. Two, I want to account for money I'm paying toward the mortgage. This is cash flow, money coming from my bank account toward my policy, and I'm also still paying the mortgage at this point in time. Then, if I'm pulling loans from my policy to chunk down my mortgage, that means there's going to be interest on those loans, which if I'm paying them, I want to account for that interest. If I'm not paying them, I want to look at the cumulative interest that will accrue on that policy loan over time. We're going to look at exactly that too. My point is, if we're going to take the chunking approach, we just want to look at the total cash flow, because what I don't like to see happen is a situation where the cash flow going toward the plan becomes unmanageable, or it's just causing stress where someone's saying, I got my premium, my PUA, my mortgage payment, I got the interest on the life insurance loan. It's just too much. Even if the numbers work, I'm stressing out. Like it's just not working for me personally. If you've ever felt like that, that would be a situation where I'd say, okay, we could still lay the numbers out, but this might not be the route to go, which is where we look at option two. But in a case like this, if the cash flow does become unmanageable, what I mean here is we're paying the premium, mortgage payment, and then loan interest, is what we could do is always reduce our PUA payment. So with a whole life insurance policy, I can pay money toward the base premium or my paid up additions rider. PUAs, that's my paid up additions rider, immediately accelerate the cash value growth. The PUA payments are very, very flexible. So if someone has a policy where they want to fund $20,000 per year, the lowest I could set that premium might be $2,000 with those four major mutual companies, which means the other 18 grand is going to PUAs. So if I take a $100,000 loan against that policy to chunk my mortgage down, make a big payment toward it, well, if the loan interest is 5%, that's $5,000 in loan interest for the year. If that is unmanageable, meaning someone says, I can't swing that, like it's going to cut into my budgeting, like that's not going to work. Well, then what we would do if they're going the chunking route is reduce my policy funding from $20K per year to $15,000 per year. This way, my net out of pocket does not change. That's one option. The other option is to just not pay the loan interest, which sometimes can work. We're going to look at an example of that with respect to chunking in a little bit. But what chunking is just taking loans from your policy and paying down the mortgage as quickly as possible. So that's one option. The other option is doing it with a lump sum. And this is a lot easier. So what this involves is building cash value until you have enough money to borrow against the policy and pay off the mortgage. Then I pay it off. It could be in two payments if you've got a large balance, but this is just the classic approach. I'm going to save enough money until I could just pay it off in a lump sum. You will pay a little bit more in interest with this option, but it makes life a whole lot easier. And you also see your cash value just grow and grow and grow until you drain the balance to pay off your mortgage, but it keeps compounding. We'll look at an example. So step 4 here was what? Using the policy to pay off the mortgage. You can do it by constantly throwing money at the balance, or you can do it through a lump sum payment. And again, we will look at examples in a little bit. Now, what do I do after I pay the mortgage off? Now what? Well, now the next step is to repay the policy loan. How would you do that? Instead of coming up with extra cash, what you could do is just redirect your mortgage payment, meaning the monthly payment you were paying toward the mortgage. Since you don't have that mortgage anymore, now you can apply it toward the policy loan. That's usually what people do. And if they have extra cash, they might throw it at the policy loan as well. Now, I always like to add this piece here. What if I want to pay that policy loan off fast and I want to pay the least amount of interest possible to both the bank and the insurance company? Well, here's a pretty cool option that's available. You could stop your premium payments altogether. And then in addition to redirecting your mortgage payments to the loan, you can also redirect your premium payments to the policy loan. We'll show you that too. It's fun to look at that because you can see the actual savings just increase then. And then after the policy loan is repaid, we like to review the following. What was the total interest I paid to the bank? The total interest I paid to the insurance company. And then go back to step 1, reviewing the current mortgage. When I compare the two options, how much interest will I save by using the insurance policy? How much cash value will I have at the end of the road? And then I ask myself this question. No one else, just myself. Is it worth it? And then you can ask others, of course, too, especially if they are financially astute and you trust them. But I always like to start, is it worth it? Just to simplify things because the stuff is not always simple. All right, let's look at some examples. I hope that that was informative. We're going to look at several examples. First, we will look at an example of Joe. He just took out a new mortgage. He's looking to get a new life insurance policy, and he specifically wants to see if he can use that policy to pay off his mortgage through the chunking strategy. Let's take a look. So, what we have first is his illustration. In fact, let's look at this a little bit differently before we just dive into the illustration. So for Joe, his mortgage details. He's got more than 29 years remaining. He just started this. The balance is just under $550,000. The interest rate is just over 6%. His current monthly payment is about $3,400, which comes out to a yearly amount of $41,000. This is what he's paying on his 30-year mortgage. If we look at the total interest payments over the next 29 years, it's going to come out to $626,000 and change, which is just pure interest he'll pay to the bank. We're going to look at the schedule so you can see it month by month, and then we'll look at it yearly. So that is what things look like if he just keeps paying the mortgage as is. So his goal is to see if it makes sense to pay off the mortgage with a whole life insurance policy. Here's why he's interested in this. When he looks at the mortgage, he's got compound interest, and 30-year and 15-year mortgages, they're front-loaded in terms of the interest. Whereas with a life insurance policy, when I borrow against it, I've got that annual simple interest. Here's the big item though, number 3, with the life insurance policy, the cash value keeps compounding when the money is borrowed. So what this means is if Joe just saves money in this policy and at retirement, call it 65, it's worth 800 grand. If he decides to use the policy to pay off the mortgage and then pay that loan back by the time he retires, he's got the same $800,000 in cash value. That hits on that third item where I can save for retirement at the same time. So conceptually, sounds good, and that's why he's interested in doing it. Let's look at the plan though. So step 1, we'll break this down into steps to keep it simple. Step 1, open a whole life insurance policy. Here's what he can do in his specific situation. He can fund $2,000 per month, which comes out to $24K per year. He also can throw an extra lump sum into the policy of $20,000 for the first year and the second year. So what that means is years 1 and 2, his total payment into the policy will be about $44,000. The monthly payments plus the lump sum. So he's got some excess cash that he can kickstart a policy with, which will help him a lot, actually. So that's step one, open the whole life insurance policy. Step two, take loans immediately to begin paying down the mortgage. What he's going to look at is taking policy loans of $20,000 per year, and he's applying this $20,000 per year loan he's taking from his policy to the mortgage. It would be the same thing as if I just took $20,000 if I were saving it in cash and just making extra principal payments toward the mortgage. I'm doing the same thing. I'm just funneling it through the policy first. And what I'll see here is in 13 years, instead of 29 years, the mortgage will be paid in full. And you own the home free and clear. Woohoo! All right. So step two is the chunk strategy, which again involves paying down the loan immediately. Okay. And then step three, here we go. After that loan is paid, he wants to pay it back. What we're going to do is redirect the policy funding and the mortgage payments toward the policy loan. So what this means is policy funding, which was $24K per year, we're not going to pay that toward his premium and PUA rider anymore. Instead, we're going to redirect it to the policy loan. His mortgage payments, which were about $41,000 per year, well, those will be gone. We're going to keep up the habit of cash flow here and redirect that toward the policy loan. So let's take a look at the numbers. We'll walk through this one item at a time. So first, we've got the illustration. Here's what he's funding. Okay, great. Let's take a look at it on Excel, shall we? So here's his policy. This is the same thing we just looked at via the PDF. What's highlighted in yellow represents the break-even point between years 3 and 4, and then you've got the net yield on the far right. Okay, that's great. Then we've got the mortgage schedule. You ever request one of these from your bank? It's always on a PDF, and depending on how many years you have left on your mortgage, they're usually like 7 or 8 pages long. They're massive. But what's nice about them is usually they can easily be converted to Excel, like we see here. But we see our balance, monthly payment. Here's what he's actually paying in purple. And then of his payment, we can see how much is going to principal and how much is going to interest. With mortgages, they're front loaded in interest. Like that's what's going to happen. So we can scroll down here, but I'm not going to do that because it goes on and on and on. What we did is condensed it. So what we've got here is the exact same thing, just annualized. So he just started this mortgage. He's got more than a full 29 years, which is why at the bottom we see a year 30, but there's not that much left. He's got a little bit more than 29 years left on his mortgage now. So we see his current balance, okay? His monthly payment, highlighted in this beige color, is the yearly payment. Now we can see on a yearly basis how much goes toward principal, how much goes toward interest. And then we have the total interest that is tallied up over time. There's that $626,000 in change if he just pays the mortgage like most people who have mortgages. They just pay it off 1 month at a time, and then 30 years down the road, they're finally free and clear. This is why banks make so much money, by the way. Okay, so ready to look at the numbers? Here we go. Here's his policy. We've got this extra column here that shows the death benefit figures with the loan. Next, we've got the mortgage. So what we've got going on here, there's the yearly mortgage payment. So when we execute this strategy, of chunking down a mortgage with loans, we're still paying on the mortgage. We still have that regular payment every month in this example. And again, we can see how much is going toward principal, how much is going toward interest. But what we've got here is, you'll notice in this example, it doesn't take 30 years for it to be paid off. Why is that? You'll see in a minute. But once the mortgage is paid off, then cash flow is freed up. Specifically, what's freed up is the mortgage payment, which that is $4,750, and then the policy payment, which is $24,000 and change. Add the two together, total cash flow that we looked at earlier on the Word document is $64,000 and change. All right, so here's what's going on here. Let me just clean this up real quick. Nice. That's what that's supposed to look like. So he starts the policy, puts 44 in. He has 38 in cash value. The first year, he takes a policy loan of $20,000. The maximum loan here, before we took this loan out, was $38,000 and change. After taking the loan, it's $18,000 and change. So the cash value is your equity. That's how much you can access. So he takes this policy loan, and what he's doing is applying it toward the mortgage balance. So we have this factored in here. Do you remember what it was before? It wasn't 527. It was a bit higher than that. Why it's less is we threw 20 grand at the principal here. So he's going to do that year in and year out. He's taking $20,000 per year. And what you'll notice as these loans come out, the mortgage balance is decreasing. I've got my monthly payments. Here's the yearly amount plus the extra 20K that's going toward it. So by 2037, there we go. It's actually 2038. That mortgage is paid off in full. There's a lot going on here, I know. But here's what I would look at. Total interest paid to the mortgage. And then also, over here, the total interest paid to the insurance company. So what we've got here is the loan interest. This is going to show how much interest we're paying to the insurance company on a yearly basis. Down here, what happens with the interest on a yearly basis? Comes down. Why? Look to the left. After 2037, I stop paying on the policy. So I'm no longer paying on that policy. Number two, over here, I'm no longer paying on the mortgage. What I'm doing is taking those two figures, what I was paying on the mortgage, 40,000 and change, plus the $24,000 payment, add them together. And in light blue here, I'm applying that toward the loan payment. See what's going on? A lot going on, I know. Here's what we're going to look at. This will make it much easier, the before and after. So, total mortgage payments with the original plan. If I just pay on the mortgage like everyone else. The total payments that I will pay to the bank, which includes principal and interest, is just under $1.2 million. That's for a loan that's $500,000 and change right now. Whereas the strategy with the policy, the total payments I'll make to the bank, $823,000 and change. Okay, so with the policy, I am going to pay less to the bank, which makes sense. Now, what about mortgage interest? Well, if I keep doing what I'm doing, I'm going to pay the bank $626,000 and change. With the life insurance policy, the total mortgage interest that I'll pay to the bank is $268,000 and change. The reason why is because I've chunked down that mortgage faster, which saved me a ton of interest as a result. What about the life insurance company? Here's the policy interest. Original, meaning no life insurance policy and just pay on the mortgage. I don't pay any policy interest because I don't have a policy with this strategy. Whereas with the policy, the total loan interest I would pay would be $176,000 and change. We can go back to that spreadsheet, and here's our total interest paid to the insurance company, 176 and change. Okay. So here we go. The original plan, paying just the interest to the bank, 626 and change. Whereas with the policy, I pay 268 to the bank and then 176 to the life insurance company, which means the total interest I've paid is, call it, 445. Which one's the winner? Policy. The interest savings is over $180,000. That's how much interest he'll save by doing this exact strategy, by paying the mortgage down with his life insurance policy. What other benefits are there? Well, the mortgage, instead of being paid off in 29 years, paid off in less than half the time, a little bit less than 14 years from now. And then that loan is fully paid off by the time he's 61 years old. And then by the time he's 65, look at that. There's that cash value of just north of $800,000. So he saved $180,000 in interest, and then also had the peace of mind that his money is going to keep compounding, and by the time he retires, will be worth around $800,000 in change. Now, that is based on the current dividend rate. Things will change over time, but I think you see the concept. In fact, let's look at this. So to put that in perspective, here's that original illustration. Here's what he paid. He stopped at 52 because that's when he started to take that cash flow, $2,000 per month, and pay it toward the mortgage. So total out of pocket is $352. Doesn't pay anything else in ever after that in terms of premium payments. Then we've got our cash value over here on the right. If we look at it by age 65, that's where we got that 808 figure from the actual life insurance illustration. See what's going on? All right, back to our Word document. Here we go. So I'll recap here. The results are as follows. If he makes no changes, the total interest he'll pay with the original plan to the bank, $626,000 and change. If we make changes and use the policy, the interest he'll pay to the bank is $268 and change. The interest he'll pay to the insurance company, $176 and change. The total interest he'll pay with the strategy, just about $445, but compared to the $626, that's over a $180,000 savings there. And he's got $800,000 in cash value. So that was the chunking strategy. And I'll say this too, that was definitely the more complex one. The next couple ones will be a bit easier to follow. If you could follow that one, kudos to you. It took me a couple times just to go through that. But that is how Joe plans to use a policy to pay off a mortgage. Next, let's look at Roger and Amy here. So, details on their mortgage. They've got 26 years left. Their balance, 516 and change. Interest rate, 6.25. Monthly payment, similar, $3,300 and change, comes out to just under 40 grand per year. The total interest that they will pay over the next 26 years, if they just pay the mortgage every month, is just under $550,000. And some additional information, they have recently been paying $1,000 per month toward the principal in extra payments. And that's important because we're going to factor that in. So, firstly, whole life insurance policies. Roger and Amy, I've actually been working with them since 2018. So they've been saving money for a while now. So Roger is funding his policy with $6,350 per year. His current cash value is almost $53,000. Amy is funding just over 10 grand per year, and she has a cash value of $335,000 and change. Now, with Amy's policy, they did aggressively fund her policy in the early years with some large lump sums, which is why she has so much cash value. But they've performed quite well over the years. So the goal is to pay off the mortgage with the life insurance policies. The reason why? Well, it's going to A, significantly reduce the amount of interest they pay to the bank, which also results in less stress and a better credit score. The life insurance loans are annual simple interest when we look at that. And then similar to Joe, my cash value continues to earn dividends and interest when I borrow against it. So let's break this down into 3 steps, just like we did for Joe. Step 1, what are they going to do? Firstly, look at the cash flow. What we'll do is redirect those extra mortgage payments of $1,000 per month toward their policies. So when we look at Roger's cash flow, $6,350, we're going to increase that to $10K per year. That's an increase of $3,650. Amy's policy will increase from $10,600 to $20,000 per year. That's $9,400. You may have noticed that's an increase of $13,000 per year, where the extra $1,000 per month comes out to $12K. We rounded up $1,000 per year, and the reason why is because it just made the funding a clean 30 grand per year. It made the numbers easier. That's why we did that in this specific case, and it wasn't difficult for them from a cash flow perspective. But that's step 1, increasing the policy funding, and we're primarily doing that with the extra mortgage payments. Step 2, stop funding your policy and pay off the mortgage balance. So what we're doing here in 2028 is we're going to stop paying the premium altogether, which means our funding will be 0. And then in 2028, we're going to take a huge policy loan and pay the mortgage off in full. So this will display the lump sum scenario instead of the chunking scenario. And you own your home free and clear. Woohoo! All right. And then we've got step 3. After that mortgage is paid, just like Joe, we're going to redirect our policy funding and also our mortgage payments toward paying back the loan. Our policy funding was what? $30K per year. Our mortgage payment was what? Just about $40K per year. Add the two together, about $70,000 per year. We rounded up the $102 to make it a clean $70,000 per year. Want to see the numbers? All right, let's take a look. So here we go. First, we've got Roger's whole life policy. Then we've got Amy's whole life policy. Notice they're in policy year 7 because they started these when? Back in 2018. Then we've got the combined values. So this makes it easy when we look at the mortgage strategy. It is going to be based on the combined policy values here. When we look at the mortgages, what do we have? Here's the broken down monthly statement he sent. Look at that. Balance, dark red, purple, his monthly payment of $3,300. Dark blue, how much of his monthly payment is going to principal, and in red, how much of his monthly payment is going to interest. Then we've got the same thing, but with a yearly breakdown. At the end, what do you notice here? Total interest, he's going to pay to the bank almost $550,000. That's a lot. So let's look at the strategy. What we've got first, the policy values. These are the combined values we just looked at. There's your $30K per year just for 3 more years. After that, they're going to stop. Next, we've got the mortgage. So what's going on here? Here's your balance. What is he paying? Just about $40K per year through 2028. These are pulled from the last sheet we just looked at, his mortgage statement, because through 2028, he's going to do nothing other than just keep on making regular payments toward his mortgage. We're not doing chunking here. So you can see of his payment, how much goes toward principal, how much goes toward interest. Where's most of his money going? Toward interest. And then we can see the total interest paid, assuming that mortgage is gone in 2028. If we just stop there, you could probably see the difference, right? What was his mortgage if he just keeps doing what he's doing in terms of total interest payments? Yeah, 545. Now it's going to be 97. But we've got to factor in the policy loan interest. So here's our cash flow. Mortgage payment, here 0. Policy payment, here it's 0. The reason why is because for these 3 years through 2028, we're actually paying the mortgage. The policy, we're actually funding it. So if it reads 0 under cash flow, that's because this cash flow is not free. It's going toward the policy and the mortgage. Now, why I see numbers start in 2029 is because at this point in time, we're assuming we do this. Here's a big old policy loan. So in 2028, I'll back up a year. Without any loans, your cash value is $535. He takes a loan of $491,000. This is taking a loan from his policy and also his wife Amy's policy. His available equity drops significantly because he's draining the policy. But then he takes this loan and pays off the mortgage. See what's going on here? So now we no longer have a mortgage balance. But what do we have in its place? A big fat policy loan. The interest rate on this policy, by the way, is 6%, but it does not accrue like a mortgage. So what we're going to do now, going back to the cash flow piece we mentioned earlier, in 2029, we're no longer paying the mortgage because the mortgage is gone, but we're going to take that cash flow and pay it toward the policy loan. The policy payment, we're not paying it anymore, but we're going to take that cash flow, pretend we're still paying it, but pay it toward the policy loan. See what's going on here? Keeping the cash flow the same, just redirecting where it's going. So add those two together, 70 grand, we rounded up to $100 or $102. Here's our loan payment every year. We continue to pay this. Here's the loan balance on the life insurance policy being paid down. And when it's paid off, we can see the total interest we've paid to the life insurance company. This is so important to look at. So I can see with the whole strategy, what's the total I paid to the bank versus what's the total I paid to the insurance company. So what are the results? You can see the interest I paid to the bank and the insurance company over here. The number at the bottom is the total, by the way. Let's take a look. Want to look at the same before and after? I do. Okay. So the total mortgage payments that he'll make are as follows. If he just keeps on paying on his mortgage as is, it'll be a total of just over $1 million. That includes principal and interest. So it's the 545 in interest, and then the balance is the principal payments. That's where that 1 million comes from. Whereas with the policy, 123 and change, plus the principal technically, right? But let's continue on here. Here we go. Come on. Thank you. Mortgage interest. If he just continues to pay on the mortgage, 545 and change. With the policy, $97,000 in interest. Okay, there's the big difference right there. Policy interest. If he goes with the original plan, he doesn't use his life insurance policy, which means he pays no interest to the insurance company. Whereas using the policy, he's going to pay the insurance company $166,000 in loan interest. But even with that, that is significantly less than what he would just pay to the bank. This is mainly because of how the loan interest accrues. Again, it's front loaded with mortgages. That's why it makes it easy for the strategy to look favorable. So the interest savings is similar to Joe's plus 100K, it's 281 and change. Instead of taking 26 years, he paid it off in about 3.5 years. To be fair, though, he has been saving in his policies for several years. And then he inquired about paying off the mortgage early and using his policies. So the mortgage came after he had already started his whole life insurance policies, which is how he was able to do this so quickly. But if someone's starting with a lump sum, they can mimic something similar to this. We would just run the numbers through and show them exactly what it looks like. And then at age 65, if we look at the total cash value, and we'll look at his age 65, which will be 2049. There's the combined cash value of $1.4 million in change. So his money kept on compounding all the way through, so we could use this to pay off the mortgage early and have that big pile of cash at the end of the road. So let's recap this strategy. The results are as follows. If you don't make any changes, I pay $545,000 to the bank in interest. If I make changes and use my life insurance policy, I pay $97,000 to the bank in interest. I pay $166,000 to the insurance company in interest, which comes out to a total of $263,000 in interest, and I save $281,000. Like, that's the big savings right there. And I still have more than $1 million, my $1.4 million when I retire. Make sense? I hope it did. That is exactly what people are doing to pay their mortgages off with their life insurance policies. Let's look at the other two examples very quickly. We don't have an itemized breakdown for these two. I'm just going to go through these two rather quickly. So these are longtime clients. First, we have a nurse. Here we go. So with her policy, she started in January of 2021. She's funded her policy quite aggressively. Here's the annual funding, $72,000 and change per year. And before even speaking with her, meaning after she had the policy set up, she said, yeah, I've been using this to pay off my mortgage. And that's my goal, to pay the mortgage off in full. I'm like, oh, okay, let's look at the numbers. So what we've got on the left is the red box represents what's already happened because you started in 2021. Today we're in 2025. Total payments, cash value, annual cash value growth represents what she's getting from the insurance company every year. Here we go. We looked at this in 2024, took a loan of $190,000. Now, the loan balance is 175. Why? The reason why is because when she pays that, makes that $190,000, takes the $190,000 loan from her policy, she immediately pays off the balance of her mortgage. That's the remaining balance. And then she had $2,000 per month that was going toward her mortgage payment, which is now freed up. So she can immediately start to redirect that toward her policy loan, which is her plan. She's extremely disciplined. So when she makes those payments of $2,000 per month, she sees how much in purple is applied to the principal, and then in red, how much is applied to the loan interest. So I can see that it's being paid back. There's my loan balance, 0. How much did she pay in interest to the insurance company? $55,000. A whole lot less than what she would have paid to the bank in her particular case. And there's her cash value at the bottom as well, restored a little bit higher actually than what she had originally had projected with no loans. The reason why is because her policy is a direct recognition policy, where when we ran these illustrations, the company actually kicked the dividend rate up on borrowed funds, which some direct recognition companies do that. But that's a nurse. Next, we've got a Lions fan. If he's watching, he knows I'm talking about him. The Lions are finally good, right? It's fun to watch them good. So he's 5 years into his policy. He's funded quite a bit. So he's aggressively funded in the early years. To get 725 into the policy over 5 years, you've got to be slugging a significant amount of cash into the policy. And here's his break-even point, 2024. So there's his cash value. He took just over a $700,000 loan. He's already taken this loan, so this is in action right now. And then what we've got is a situation where he doesn't plan on aggressively funding the policy. He's going to pay just his minimum premium. What we have to the right, we see the interest rate. But what do you notice about the interest payment? 1, 2, 3 years. It's exactly the same. Why? Well, for 3 years, he's making interest-only payments. He's not paying anything toward the principal. He's still working on his home. He wants time before he pays it back. He can take as long as he'd like. This loan interest rate is also a fixed loan interest rate. We didn't talk about variable and fixed loan rates very much, but we've got a fixed one here. So here, pays interest only. And then in 2027, he's going to start attacking the loan principal aggressively. There we go. Until it's repaid. And there's his cash value then, restored at $1.1 million, which is what it would have been if he just let it sit and grow. Now, what we really looked at in his case, because this was a large loan and he's put a lot of money into his policy, is the spread. So we can see when he takes that $716,000 loan, this particular year, his cash value growth is almost $26,000. But the interest he pays on a fixed loan interest rate is $40,000 and change, which means when we isolate just the policy, he is negative. Now, it's a lot less negative than what he would have if he financed it with a bank, but it is negative, and we've got to highlight that fact. Like, yes, there's good about it, but there's drawbacks too. We've got to highlight it so he has awareness. So he's negative, negative, negative. Once he starts to throw a little money at the principal, now we see the growth exceeds the interest. Remember, what did we cover in the beginning? When you take a loan, you still earn dividends and interest on your full cash value. It keeps compounding. That's why people do this. They get the constant compounding all the way through. So the spread shows me each and every year, am I getting more from the insurance company than what I'm paying? This way I just have transparency here. But that is his particular situation, and this is actually in progress right now, which I think is pretty cool. So those are our examples. All right, we are just about at the end here. So I know that that was a ton of information. I do hope that you enjoyed it. If you're looking at this and saying, okay, like I am interested in seeing if this can potentially work for me, what do I need to do to see if this can work for me? Well, here's what we would need specifically. Not a whole lot. Firstly, it's just a mortgage schedule. And if you can't get one from the bank, there are calculators that we can look at online. We can work on it with you to make sure everything looks 100% accurate. But first, we do need a mortgage schedule. A recent mortgage statement helps a lot. And then information about your cash flow. We do have a questionnaire that we can provide that collects this. Also, this is something we typically like to meet with people too, especially if they need help getting an idea of what their cash flow looks like, because the more accurate things are before we put the models together, the cleaner the models are, and it requires less reruns and such. But we primarily just need a mortgage schedule, mortgage statement, and then information about your cash flow, which would really just be used to fund the life insurance policy. And then we'll start to model the loans and such. That's primarily what we would need to build this out for you. And if you're interested, what I will say is if you'd like to meet and review the numbers, we have included a link in the chat, whether you're on YouTube or on Zoom, where you can schedule an appointment with us. If you book a meeting there, I will say that it is on a first come, first serve basis, as with the mortgage clients we work with. It is something that our associates work on with, but I work on everything with them as well, just because we do just like to go through everything thoroughly. So you can certainly schedule, but just heads up, it is on a first come, first serve basis. If there's a wait time, we'll certainly let you know. And then if you're at a point in time where you say, hey, I'd like more information before connecting, we included another link in the chat. You can also visit our website for this, where you can download our free guide, which covers one of the case studies, actually the lump sum case study we had talked about, where it just breaks down exactly what the client did. So we've got the 3 steps. We talk about how he was able to save $280,000 in interest payments to the bank, and we just lay out the details, talk about his policy, why he's interested, and then the plan. Steps 1. There's the numbers. 2. How's it work? There's the numbers. And then on to step 3. But you can also get that guide through the other link. And if you can't find it, you can certainly visit our website, ibcglobalinc.com, and or you can email us and we'll certainly email it your way as well. Or you can give us a call. So with all of that said, thank you so very much for staying all the way through. I hope that you enjoyed this evening's webinar. We are going to open the floor to questions, but before we do that, let's take just a quick 5-minute break. I'll be right back, but we'll take a break just to get a drink of water, use the restroom, and then we'll come back and have questions about using a whole life insurance policy to pay off a mortgage or all things whole life insurance. Thank you so much. We'll talk to you soon. All right, everyone. Thanks so much for the break. Much appreciated. Hope the weather's warming up wherever you live. It's finally warming up over here, and I love it because the cold, never that much fun. All right, let's take a look at some of the questions that came through. Thank you so much just for the participation. All right. So, firstly, I have a cash value life insurance policy already. How can I get coaching on these concepts one-on-one? So really good question. I'm assuming you have a policy through us. If so, I would just reach out to your associate at our company and since you've got a policy with us already, we can certainly schedule some time, go through everything. The example that you saw where we helped someone who started policies in 2016 or 2018, same thing. So he had policies for a long time, and then we showed him exactly what he could do. So if you've got a policy with us already, we'll help you, no problem. If you do not have a policy with us, my encouragement would be to work with your current agent. You could certainly reach out to us. We can see if there's something we can do, but we don't want to step on any toes if you've got a point of contact that sold that policy for you initially. Next question here. Hi, Steve. Have you done the calculations with a direct recognition mutual company? Should we expect more time to pay the mortgage as dividends are only paid on the non-borrowed funds? So a really good question about direct recognition. So yes, we have done the calculation. Actually, some of those examples you saw were with direct recognition. And with direct recognition, there's definitely a big misconception about it. And what that misconception is that when you borrow against a policy, you don't receive dividends on the funds you borrowed, or you get a reduced dividend every single time. With direct recognition, what will always happen is you still get dividends on your entire cash value. The difference is the borrowed portion receives a dividend that is different than whatever the standard dividend rate is. And what I will say is different life insurance companies have different rules. Some lower the dividend rate, some raise the dividend rate on borrowed funds. We do have some case studies and videos that specifically focus on certain companies. If you would like to see any of those, let us know. You can email us if you prefer, or you can visit our website. And if you if you submit your contact info, I just put somewhere in the notes that you're interested in seeing some direct and non-direct recognition case studies, and we can certainly get you that information. But what I will say is you still get dividends on everything. In kind of a end of the road conclusion, there's not much difference between direct and non-direct recognition, especially when you're looking at the major mutual companies. I have never seen a huge net difference on the cash value performance. The reason why is because with non-direct recognition, I usually have a variable loan interest rate, which can get higher. It has in recent years. Whereas with direct recognition, I've got a fixed loan interest rate, which in many cases can be 5% or less. So what ends up happening is if I go with a company that reduces my dividend rate on borrowed funds, in many cases, what we see is we're paying less in loan interest, which evens things out. So when we look at the net results accounting for the amount we've paid in loan interest, there's not much of a difference there. But we've got case studies that break the numbers down line by line if you're interested in that. But the answer to your question is those mortgage strategies will be very, very similar, regardless if I'm looking at non-direct or direct recognition. Another question here. How can you add more payments in the back end of a policy as you started with 33K? Really good question. So the example for Roger and Amy, where they were funding, she was funding 10 grand and he was funding 6,300, and then we increased it to a total of 30,000. So what we did is increase the paid up additions rider. So with a whole life insurance policy, when you pay money into a policy, it can go toward the base premium or the PUA rider. The PUA rider is what maximizes the cash value. Now, what you'll find is different life insurance companies have different PUA rider rules, and how you set the policy up can make the policy very flexible or not flexible at all. Roger and Amy have policies with Guardian. Guardian is a company that will allow you to just throw money into PUAs at your discretion. The most we can illustrate is actually up to 10 times the minimum base premium per year. So their policies were set up where they have the ability to just pour extra money into PUAs whenever they want, and that's exactly what they did. Now, depending on how versed you are in life insurance, we've got what's called a modified endowment contract. We've got to make sure we prevent that from happening, which we did. But you can easily add more money to an existing policy, provided it was set up correctly from the get-go. And some companies you can literally just like go on your mobile app and send funds via ACH from your bank account. Like that's what most of our clients will do when it's set up the right way. Another question here. With Roger and Amy's case, how is it possible to increase the policy funding after a few years have passed since their policies were set up in 2018? Are you assuming they haven't reached their MEC limit with the original policy payment? Good question. So, yes, they have not reached their MEC limit. So their MEC limits were actually a bit higher. For Amy, her MEC limit was about 100K per year. In the first couple of years, she funded up to 100K. Then she's been paying just 10,600 per year. So she's had about $90,000 in MEC space every year. And with the MEC rule, it's an IRS rule, it's cumulative. Unused MEC space will roll over year to year. That's been compounding. The same is true of Rogers' policy. So they both have a ton of unused MEC space where they can just keep on funneling money into the policy, which if they want to resume payments way down the road after the policy loan's paid off, they might do that too. But yes, they're MEC tested. For those two, they've got plenty of MEC space and the policy set up with a term rider where they can just pour extra funds into PUAs without underwriting. Thanks for that question, though. Really, really good question. Next question from Iris. Is it possible to see how the internal rate of return is affected by the loaned amounts? Do you recommend to have a non-direct recognition company for this strategy? So good question. It is possible to see that. I would refer back to my comments to your earlier question about the non-direct and direct recognition case study. As we do break that down, again, you're going to find that the net impact is minimal, especially if we associate an IRR with the interest payments we're paying to the insurance company as well. I will say this, we use both direct and non-direct recognition. Non-direct recognition is a whole lot easier to understand and explain because I know when I borrow and repay, my value is going to be exactly the same when I pay it back. Whereas with direct recognition, it's going to be different. Could be higher, could be lower. If you remember the nurse's case study we looked at earlier, when she borrowed and repaid, it's a little bit higher. The reason why is because she had a direct recognition policy where the dividend rate was raised on the borrowed funds. That's why it was a little bit higher in her particular case. So again, it does heavily matter on the company and their direct recognition strategy. But I would definitely reach out and we can certainly let you know. All right, let's continue on. See a question from Joy. Thank you. Really appreciate that. And yes, diligence is one of the most important things. All right, next. I already have an existing policy loan of about $100,000. Should I pay off the loan first before I start the process of paying down my mortgage, or is it possible to start paying a lump sum toward my mortgage while paying down the policy? I love that question. So it's possible to start paying down the mortgage with loans right now. Very easy to do. You can do that. Here's what I will say. Just from a mental accounting standpoint, it can be much easier to pay off the loan first. If you just want to say, I want to start with a zero balance with respect to my policy loan. This way, when I use this strategy, I can see the total interest I'm paying to the bank and the insurance company when I'm focusing just on the mortgage. So if you'd like to see, kind of like what we did for Roger and Amy, and then also for Joe, paying off the loan first will allow you to do that. If you said, I don't really care about that, I know I'm going to save a ton of interest, I want to start using it now, you could do that as well. It'll just be a little bit harder to account for the total interest because you have a loan outstanding. But I would bet you'll probably still see an interest savings even with that 100K loan outstanding too, depending on how recent you started your mortgage. But I hope that was clear. You can go either way, but it might be easier just to keep the numbers clean if the loan's paid off first. Question on the PUAs again. How can we add PUAs or can we add PUAs in the middle of the year with any policy during any policy year? So with PUA payments, it does depend on the company. So I'll give you a couple examples. If you look at some of the major mutual companies, talked about Guardian. They're a company that allows you to just throw PUAs in anytime you want without underwriting. If you have what is called a 1-year term insurance rider, then you can go up to 10x the base premium and just throw the money in. If you go with Mass Mutual, their PUA riders are not quite as flexible. They've got three different versions. They've got their LISR, their scheduled AILR, unscheduled AILR, and then planned AILRs. That's technically four different versions. But to simplify with MassMutual, when you use a combination of LISR and scheduled AILR, you can typically adjust your PUA payment one time per year, every year, on your policy anniversary date without any medical underwriting. So the difference between Mass and Guardian is Guardian, I can just throw them in at leisure, whereas with Mass, if I'm comfortable with a one time per year payment adjustment where I'm scaling that PUA up and down, then I can do that. Again, without having to go through underwriting, saying, hey, my health has changed, and I got to deal with all that stuff. If I look at some smaller companies like Lafayette Life, for example, they have rules similar to Guardian, where I can just throw money into PUAs at my discretion. The thing with them is they've got a rule that I want to be aware of is I have to be underwritten and approved for the maximum PUA I can add to the policy up front. And then I've got the first 7 years. They're going to look at how much I've paid into my PUA rider. Then they're going to say, okay, you've thrown in this much money. Say it's $700,000 you've added to PUAs over 7 years. They'll take that total PUA deposit, divide it by 700 divided by 7 is 100K. And now that is your new annual maximum that you can add into PUAs every year without medical underwriting. The important item to be aware of with them is after the 7th year, how much did I add? Then they're going to take that average amount, and that's my new maximum moving forward. But I can add any time I'd like at my discretion. My point is, all insurance companies have different rules when it comes to PUA flexibility. I will say, if you'd like more information on that, I can certainly visit our website. If you come across the site or shoot us an email, we can send you some info. We do have a video that actually goes through 5 different life insurance companies. It's MassMutual, Guardian, Penn Mutual, Lafayette Life, and New York Life. And we just go into details of their PUA rider flexibility. We can certainly send that your way. Really good question, though. Next question. What's the cutoff age for this to work? That's a good question. So that has to do really with the life insurance policy and when the cash value is still efficient, meaning we can still maximize the overall growth. We've set policies up for individuals who start in their 70s, provided they're healthy, that can still work well. What I would say to answer that question is, firstly, if we're 80 or older, it is going to be tough to get a policy on ourselves. We might need to get it on our kid or perhaps our grandchildren. But if we're in our 50s or 60s, it can work. I would just have questions about your health, the dollar amount we're looking to fund a policy with. Is it a lump sum or a consistent amount? There'll be a couple questions that I have there. But there's no hard cutoff age unless I'm up there in age. If I'm in my 70s and I've got some health issues, that can be tough. Nadine, hello. Good to hear from you. Thank you. So your examples talked about after the mortgage is paid, redirecting funds toward the loan. My question is it better to pay the loan or add toward PUAs? Does the loan payment or funding the loan have the same dollar for dollar cash value or impact on cash value? Got it. So when I'm going to, after the mortgage is paid and I've got just my policy loan, should I throw money toward PUAs or toward the loan? We always like to look at both. Typically, applying it toward the loan will net me a better result, because when I look at the interest rate compared to the net growth rate on a policy, you see that it makes more sense to pay down the policy loan. But to hit on your question about the dollar for dollar impact, if I throw money toward PUAs or toward a loan, what am I going to see a stronger immediate impact with? The answer, policy loan. PUA payments do have loads or fees associated with them, meaning if I throw 10 grand into a PUA payment, the next day I might see 9,500 or 9,700 show up in cash value. Whereas with a loan payment, if I pay 10 grand toward the loan, it's going to restore 10 grand. And maybe if the company bills interest in advance, it'll save a little bit of interest too. So I'll see an immediate impact there. On the flip side, however, PUA dollars I add to a policy compound forever. So there is a long-term benefit there. What we see with a lot of real estate investors and business owners is they'll aggressively fund their policies for a period of time, borrow against their policies while they're funding it, take those loans, invest in real estate, whatever they're going to do with it. But then after they fund the policies for, call it 5 years, then they'll stop paying it, the premium that is, and take money that they were paying toward the premium and redirect that toward the loan. They're effectively running a loss typically during the first 4 to 5 years when they're loaning out the majority of their cash value because they've got that loan interest. It's exceeding the interest earned on the policy. They're just adding money into PUAs instead of paying the loan, but they're doing that because they see the long-term benefit of the cash value compounding, and they do plan to eventually pay that loan down. We've got some examples that we can send you on that if you'd like. All right, let's continue on. And I know we're meeting, I think, Wednesday. So if that didn't make sense, you can say, Steve, you got to communicate better. All right. Another question here from Iris. Do you work with Lafayette Life? I saw an illustration with their performance, and it's beating the four major mutuals. So I would say it's probably not, unless the designs were manipulated, where it was designed to favor Lafayette versus the other major mutuals. We are contracted with them. We can use them. They're not a bad company. They're A-rated. We don't use them much. I do prefer the four major mutuals. The main reason why is with whole life insurance, the biggest form of buyer's remorse I typically see is when illustrations project great looking numbers and then they underdeliver. I'm not saying Lafayette Life does that at all. That's not the intent of this. Where I've seen, though, policies deliver the strongest actual internal rates of return on cash value is when they're designed with minimum base premiums and the guaranteed values look the highest on the illustrations and with the four major mutual companies. When I worked at the executive benefits firm, going more than 10 years back now, historical performance and actual results would always come up, like every single time, because you're dealing with corporations putting in boatloads of cash. They're not going to put money in just based on what an illustration shows. So with all of that said, I like the four major mutuals because of that proof of performance. That's just my personal comfort level. A lot of my peers, even agents that are subscribed to our training business, like Lafayette Life, that's perfectly fine. But I do like the major mutuals for that reason. Regarding the illustrations, when policies are maxed out, I have not seen them deliver higher cash values than the major mutuals if everything is equal. So I would definitely examine those illustrations just to make sure that it's a fair comparison. Yeah, I would definitely do that. Another question here. What about the risk of MEC, modified endowment contract, with the major loans taken? I mean, from a tax standpoint. So policy loans actually do not impact the MEC limits or have any implications on a modified endowment contract at all. If a policy becomes a MEC and then we borrow against it, then we'll have to deal with taxes on the gains and unpaid loan interest with MECs. Actually, we'll get a 1099 for that every year, but we don't have to worry about a MEC in that particular case with the loans outstanding. If a policy lapses with a loan, even if it's not a MEC, that would trigger a potential taxable event on the gains and unpaid loan interest. But typically, loans won't have any bearing on the modified endowment contract. Good question, though, because that is important. Next question. Is the interest rate on the loan you borrowed fixed? Or if you pay it back in a shorter time frame, does it reduce the interest rate? So the loan interest rates in the examples we looked at were fixed for the most part for Roger and Amy. It was a fixed loan interest rate of 6%, which if they paid the loan interest annually on the anniversary date, it was discounted to 5.66%. They had older Guardian products that function in that way. For Joe, that product had a 5% fixed loan interest rate, where the interest rate was discounted to 4.76% if he pays the interest out of pocket. If he doesn't pay it one time per year when it comes due, it's 5%. Depends on the company. Different companies have different rules. For the business owner example we looked at, which was the 35-year-old individual who funded $50K per year and then took that $150,000 loan, his loan rate was variable, 5.07%. That was a Mass Mutual policy. And then we had the Lions fan. His fixed loan rate was 5.66%, and the nurse actually had the same thing as well. And then regarding paying it back in a shorter time frame, does that reduce the loan interest rate? So it can if the company charges or applies a discount. Like Guardian right now, you've got that 5% fixed loan interest rate. If I just pay the interest with cash, it's discounted to 4.76%. But if we look at the actual interest, if you pay the loan down over the course of the year, you will save yourself loan interest, because loan interest on life insurance policies accrues daily at annual simple interest. So what that means is if I'm paying it back over the course of the year, I'm going to save myself some interest. And if you'd like some content on that, let us know. You can email us or visit our website. We can certainly send you some examples where we go over exactly how loan interest works, and we've got breakdowns with different companies and such. All right, let's continue on. Good question. I'm interested in that video about PUA flexibility. Where can I look for it? Well, where can I find it? So you can find it on our YouTube channel. You could also just shoot us a note if you want to email us at info@ibcglobalinc.com, or you can visit our website and we can certainly get it to you that way. But if you type in PUA flexibility, you might find it, or you could just reach out to us. Cool. Thank you so much. Appreciate everyone's time. Have a great evening, and we'll talk to you next time. Enjoy.